What's up, guys? Wanted to do this video today for you, and really this is for people who are interested in Bell Capital investing in our fund, more just an update. I was sharing with somebody about right now is the new norm as it relates to buying multifamily real estate, investing in multifamily real estate as it relates to the rates are concerned, this climate of the market. So I was talking to my lender about that, and we were talking about how years ago the interest rates for multifamily commercial real estate tick for the debt was somewhere around 4.75, 4.5. That was a normal rate. Even now, it's at 5% or maybe five and a quarter, maybe a little sub five, depending on what type of financing you're getting. But that's normal. What's not normal was 2.75, 2%, 1.5%, like on some of these commercial debt that people got 10 years ago. Now, the difference of that is anybody who got into commercial real estate a couple of years ago that's new. You may not understand what's going on right now. A lot of these guys are losing assets and things like that. Point is this is the new norm. So a lot of the deals that maybe sellers that own properties, especially some of these bigger groups that own properties for 10 years, 7 years, and they're waiting for that rate to come down, they're also accepting the fact that, hey, this may be the way to go. Right now is probably the best we're going to get over the next year, year and a half. It doesn't make sense to extend and pretend. Let's go for it. That's the new norm. So if 5% on an interest rate, which is good, 5%, maybe 4.9, 4.8, five and a quarter, those interest rates locked in may be the new norm. So we're looking at that as it relates to our underwriting and some of the deals we're looking at. Do they pencil out there for our financing and our debt? Fannie, Freddie, debt funds, life cos, things like that. So that's number one. That this may be the new norm, and we're ready for that. All right. So the next thing that we're talking about is the debt maturities. Yes, while there are a lot of debt maturities happening right now, our like my rationale for the fund as it relates to what our target is, we're looking for distressed sellers, not distressed assets. So for us, that's newer properties, more stable, and the sellers have already went through, done their value add plan, and we may be able to come in and acquire these assets for equivalent for the same amount that they bought it for, maybe 5 years, 3 years ago, and they put the money in it. So they're walking away from their equity. Those are the targets for us. I've always done that. It's not new. I've been doing that for 20, 30 years, 27 years of my career is looking for great assets. We did the pretty real estate business, meaning like we found a distressed seller, someone who had to sell, and we would take over a nice asset. That's kind of my game. This is no different. So this isn't some new strategy, but for the fund, we're doing it at scale. So we're looking for sellers who maybe their equity wants out, they're timed up, and they need to sell, and they have to come to market, or their debt's timed out because they're in a fund. They need to unwind a fund. Maybe it's the last asset in the fund, and they've already made their profit, or once they wind down, this is the last one, and we can buy it at a discount. Either buy it for less than what it traded for or equal to what it traded for, or we can get a huge discount because the values of that property came down because they have to mark the market based on today's rates. So the last thing, which is really the main thing, that is what I wanted to share with you guys. It's like all of the opportunities that are coming up in this probably the next 18 to 24 months will be had because we can take advantage of these deals. Now, these deals are going to come at a cost. We're going to have to strike fast. You can't steal in slow motion, which is why we're doing the fund because we're recognizing something that's also true in the market right now. Um, Fund managers, people who have capital ready to go or committed capital, they're actually the preferred person to a broker. If a broker knows you can pull a deal off, they're going to bring the deals to you first, right? So when we tell people, hey, we have a fund, we're ready to go, we can pull the capital, getting the financing and the capital together is not a problem. It's a discretionary fund, so you're dealing with the decision maker. They're going to bring me a better deal. Now, if they're like, hey, I'm a syndicator, I'm going to go raise the money for my network, they're not going to bring that deal to you because they want certainty. So fund managers equal certainty to brokers as opposed to syndicators right now. They're not excited about them. Neither is Fannie. Fannie Mae is not excited about dealing with a bunch of syndicators because of what's happened over the last couple of years. Who'd have thunk that interest rates were going to stay the way that they are right now for 4 or 5 years in the making? People go to college and graduate in 4 or 5 years. No one thought that was going to happen. And someone asked me a question on the podcast the other day, like, how are you waiting so long? Now, and I want to express this to you guys because you guys will get it because you're my people. It's no different from getting married. like these deals, me as a fund manager, as owning this company, you're looking at me as a fiduciary to like protect your capital. I'm not going to go buy a bad deal to just do a deal. We're going to get married to this deal. This deal's going to be with us for a while. And I was explaining that to him. I was like, if you're doing this as a business and your number one priority is to not lose money, second, to get a deal that you know you're going to be in or can be in for 7, 10 years on a hold because you're protecting your investors' capital and it pays you cash flow, you get the tax benefits, you get the write-offs, get future appreciation, you're going to wait. A lot of people that didn't wait, those are the people that we're targeting now. The people who bought 3 years ago executed their plan and they can't get out and they have to get out at a discount. Like that's why you wait. You don't marry the first girl or guy that you go out on a blind date with. That is called a divorce, my friends. So, anyways, the goal here, like I told him, was like, hey, look, wait for the right deal. This is real estate. These are illiquid assets. The debt is tied to these deals. So sometimes the debt's 3, 5, 7 years. So once you go pencils down, just like we did, we're like, hey, we're not buying anything. We're gonna wait. We're gonna build our relationships, keep our relationships warm because it's happening to everybody, and we're gonna move in. So that's the benefit for us. So the whole goal of this was to explain to you guys, this may be the new norm. I talked about it before. Hey, man, I was wrong. I thought it was going to happen 2 years ago. So did Blackstone. So did Starwood. So did KKR. So did Equity Resident. A lot of people had it wrong. No one knew that, right? But here we are today, and this is the opportunity that's happening. We ain't wrong about that because we already see the dam breaking. So, anyways, let me know if you guys need anything. I wanted to make you this. So, the whole part of this video was explained to you guys. This is the new norm. This rate environment that's happening is the new norm. The opportunity that presents itself right now for the deals we're looking at for multifamily assets, that is the new norm for the deals. So if you're interested in what we're doing, go to bell-capital.com. You can do two things there. You can schedule a call with myself, somebody on my team, hear about our open fund, or you can go ahead and you can hit get started and you can register your account on our investor portal. You can take a look at the open fund, the documents that are there. You can see the placement. You can see our investment strategy and the returns, how it works to work with us. And you can still book that call because we're here for you. I want to physically talk to you guys. I like talking to my investors and answering any questions that you may have about your personal situation. All right. So let me know if you guys need anything. I'm here for you. Let's get after it today. Boom.